Welcome, and thank you for joining us today to learn more about the Employee Retention Tax Credit for colleges and universities. My name is Michael Wardy. I'm a certified financial planner and regional director here at Source Advisors, where we are working with our clients and their CPAs and helping them understand specific tax incentive programs and how they may be able to benefit from those programs. I am joined by Jordan Fazio, the head of our Employee Retention Tax Credit team here at Source Advisors. Since the ERC program was introduced in 2020, Jordan and his team have spent significant time in learning about the program and how to properly implement it for our clients. Over the past year, we have been working closely with universities and colleges in first educating them on what the intent of the program is, second, reviewing to verify they do in fact qualify for the benefit, and lastly, working with them to properly calculate and more importantly, document their credit. Today, Jordan is going to give an overview of the credit and how colleges and universities are eligible. If you have questions, please submit them in the questions section of the menu bar. If you are listening to the recording and have questions, please feel free to email us. My email address will be at the end of this presentation, or you can hover your phone over the QR code for access to my calendar to schedule an appointment. With that, I'm going to turn over to Jordan to start the discussion.
Thank you, Michael. Okay, employee retention tax credit. First question, of course, becomes what is it and where did it come from? So this is a CARES Act relief measure, obviously brought on by the coronavirus pandemic. We've had several different pieces of legislature come out surrounding the employee retention credit, as well as varying guidance over the past 18 months or so, as we've learned more and more and been provided, I guess, more information on how to properly handle these claims. A few of the historical items are listed there in front of you. The real key here is in 2020, we're looking at a potential benefit of up to $5,000 per employee. And because of some of those changes to the credit through the guidance and through the legislation, in 2021, we're looking at a potential maximum benefit of $28,000 per employee. We'll get into some of the details of how that is calculated and what wages we can ingest for that. But it is important to note there's been a lot of confusion regarding the PPP program and the employee retention credit. Initially, the guidance was that if you were taking one, you can't have the other. That has all been clarified. You can certainly still get employee retention credits, even if you had draw one, draw two of the PPP program. The two wages can just not produce the same benefit. So any wages forgiven through the PPP program need to be netted out of our costs prior to developing any employee retention credits. Likewise, as we are looking at 2021 credits, and some of our taxpayers have not filed for forgiveness yet, it provides an opportunity to look at the two benefits and really optimize them basis the funds available and threading the needle between the two, so to speak. This is a very important slide, and it has a lot of information on it. I would say if there's one slide to to take a snapshot of or to refer back to, it would be this one. You can see our two different credit periods, 2020 and 2021, stacked up against each other. And you can see various metrics here. Everything is baseline against 2019 values, the first full pre-pandemic year. Again, this is all going to be based on a calendar year, regardless of a fiscal calendar year end or a fiscal year end for you or not. So we're always talking about quarter one 2019 versus quarter one 2020 or quarter one 2021 when we talk about these required dips in gross receipts. If we talk about a full-time threshold, you can see there's a full-time employee threshold that indicates if you're eligible for those gross receipt declines. All of the information is based on 2019 values as the baseline. So our full-time employee headcount, as well as those quarterly results. And you can see some of the calculation difference on the top line there. Our credit amount in 2020 is 50% of the qualified wages up to $10,000 per employee. Again, a $5,000 max per employee for the entire year. In 2021, it becomes a quarterly credit worth up to $7,000 or 70% of that same $10,000 of eligible wage for each and every quarter in 2021 that you are qualified. So again, massive additional value added through some of that legislature and changes to the credit. Also, you'll notice the full-time employee threshold. It's important to note this is not full-time equivalents. It is just full-time employee on average per month. And we'll get into that definition as we go a little further here, but you'll see it increased from 100 full-time employees for the 2020 credits all the way up to 500 full-time employees for 2021. Again, intent here, make it more applicable to more taxpayers to receive some benefit and to receive some relief for what's going on. Also, our gross receipts decline. And we'll focus on this test very closely in the subsequent slides here, but you can see the required dip in gross receipts drastically reduced for the 2021 credits. So moving everything to try and make more folks qualify and get more relief out there. Okay, so most employers are eligible for these credits: colleges, universities, hospitals, 501c organizations. We don't have to be paying corporate income tax to get these credits. The key thing is that we are paying Social Security tax, FICA tax. So in order to qualify, we have to have one of the following things happening. One, fully or partially suspended operations during a calendar quarter in 2020 or 21 due to orders from a government authority. So these are government mandated shutdown orders. You can't be in this building because of COVID. There will be a period of time that mandate sits where business just cannot be conducted as normal. I think about some of our physical labs at our universities, things that just cannot be recreated virtually, right? A certain amount of education can certainly find its way into a virtual environment, but for those skilled trade type operations where there is a lab or there is a shop or there is some physical need to be in a physical location, certainly that can fit the bill. The second option, and usually the more predominant one, especially in 2021, as we don't see nearly as many, if any, government required shutdowns at this point, is the gross receipts decline test during the quarter. Again, that gross receipts decline test can be applied in 2020 if you had, on average in 2019, 100 or fewer full-time employees, and in 2021 if you had 500 or fewer full-time employees on average in 2019. If we do have the required gross receipts dip, all of the wages paid to every employee during that quarter are potentially qualified wages that can generate these credits. When we're subject to a shutdown or a partial shutdown, the qualified wages become during the period of the shutdown. And again, if we have more than 100 full-time employees on average in 2019, we cannot qualify for the 2020 gross receipts test. Likewise, more than 500 employees in 2019, we will not qualify for a gross receipts test in 2021. So those metrics are very important for the purposes of the credit. It's important to note, and maybe a little less relatable to this crowd, but aggregation rules are fully in effect. So if we have a common control of 50% threshold or greater, then we need to look at the combined gross receipts history of all entities under common control. We can't just look at the failing entity. Essentially, we have to look at them as a holistic unit, as well as the full-time employee threshold count. That would also be applied at the aggregate group level. Suspension of operations, this is a very hot topic, and you probably hear about this in the news a lot, the supply chain interruption. The definition for qualification under suspension of operation is that there is a government order specifically limiting you from conducting normal business, right? So it could be an order from a city's mayor saying that all non-essential businesses have to be closed for a specific period. We saw that really close to the epicenter of the start of the pandemic back in March, April of 2020. Haven't necessarily seen a lot of that since. Also, state emergency proclamations that people must shelter in place. We've observed restaurants where they have to social distance indoors, limiting the number of people they can get indoors that can allow them to qualify. The key here is that business cannot be conducted as normal, right? And certainly if we're talking about, we had people physically on campus at one point, and now they're unable to come to campus because of various issues or various government orders limiting the number of people in the building. There's certainly a chance to make that argument. However, it does depend a little bit on the subject matter and the nature of what is going on. If it's an easy pivot to a remote environment and conducting the education in these different remote settings, your shutdown period that you can qualify for is generally going to be limited to a ramp up session, and that's very case specific, right? How prepared were we to transition to remote already? What kind of mechanisms did we have in place? Was it strictly set up as a physical in-person education, and all of that technology had to be implemented in order to get there? So again, the bright lines are not necessarily there on the suspension of operations. It is very case by case and unique. It is important to note that even if something was declared essential, it still can be experiencing a full or partial suspension of operations. Now, the significant decline in gross receipts, this is really where most of the activity is going to be, especially in 2021. As I mentioned, those government orders are just a lot harder to come by these days, particularly that are going to limit us after having to go remote for so long. So again, 2020 quarterly revenue decline needs to be more than 50% compared to the same quarter in 2019. If that fact pattern occurs, you are qualified in that given quarter, as well as through the end of a subsequent quarter in which gross receipts failed to exceed 80%. So the important thing about that wording is that if you are qualified in a given quarter for 2020 or 2021, you are essentially automatically qualified for the following quarter because it's the end of the subsequent quarter in which those gross receipts surpass that level. So if you do have the prescribed gross receipts dip, whether it's 50% for 2020 versus those 19 values, or 20% for 2021 versus those 19 values, you're going to automatically be qualified for 2 quarters essentially. Again, in 2020, we're looking at $5,000 total, but it gives you potentially 2 quarters to find that $10,000 of eligible wages. Same is true in 2021, and we'll get into some examples of different ways this can shake out and how we can see qualification all the way across the year, even if we only have 2 dips throughout the year. And again, CARES Act does not require the significant decline in gross receipts be related to COVID in any which way, shape, or form. We just have to have that dip in gross receipts. While we're on the subject of gross receipts, this comes up quite often, particularly with the crowd we're talking to. HERF funds. HERF funds do need to be accounted for in the gross receipts analysis. If you were to assign the HERF funds for lost revenue, making up for lost revenue at the time they're assigned, we need to take that into consideration for our gross receipts dip. If you've been granted money but not requested to pull it down yet, right? If we haven't dictated exactly what we're going to use it for, it does not need to be recognized until a time in which you dictate how you are going to use it and actually request the funds. So the timing of that can become very important as well as we look at the gross receipts, because once it is dictated that you're going to use the money and have asked for it to come down, it needs to show up somewhere in those gross receipts at that point. Okay, a couple examples of significant decline in gross receipts. You can see on the top example here, we are qualified in quarter 2, 3, and 4. And you can see quarter 4 only has a 14% dip, and quarter 3 only has a 40% decline from those 2019 values. However, we had a greater than 50% drop in quarter 2 on that top example, and we were still qualified at the end of quarter 3 because our gross receipts had not exceeded 80% of those historic values. Finally, at the end of quarter 4 2020, we see the gross receipts have finally come back up above that 80% value. But you're not out of qualification until the end of that quarter in which gross receipts exceed that 80% value. So we are qualified in quarter 2, 3, and 4 for 2020 in that top example, allowing us to look at wages consumed throughout those 3 quarters to develop our $10,000 of maximum applicable wages to generate these credits. The nice thing about that as well, if we did have PPP loan proceeds, the further into the year that we're able to stay qualified for these employee retention credits just allows more maneuverability to make sure that we are maximizing our employee retention credit value while not double dipping on those PPP loan proceeds. In the example below on the bottom there, our Q2 gross receipts number is the same, a 63% decline, but we did rebound above our 80% level in Q3, so we are only qualified in Q2 and 3 with this example. 2021, again, similar test, just slightly different metric. Here you can see we only have to have a 20% reduction in gross receipts when comparing the quarterly results to 2019. In Q1, we have a 26% decline, so we are qualified. Q2, we exceeded our 80% historic level. So at the end of Q2, we are no longer qualified, but we're qualified in Q1 and 2. However, Q3, we have a greater than 20% dip again. So we are qualified through the end of the subsequent quarter in which gross receipts exceed that 80% threshold. So in this example, we're qualified in Q1, 2, 3, and 4, all the way across the board. Again, the nice thing about the 2021 credits is each quarter there is a separate credit available versus just one for the entire year in 2020. Full-time employee definition, obviously very relevant because it tells us if we're going to be able to apply that gross receipts test or not. Equivalents are not important here. It is just full-time employee headcount, and it is a monthly average. Anyone who worked at least 30 hours of service per week or 130 hours of service in the month is determined to be a full-time employee for this headcount purpose. I'll spare everyone the gory details of the averaging math. Some exclusions to qualified wages. What can we not include in that $10,000 maximum value to generate these credits? Any wages that are exempt from FICA are not going to be eligible. This doesn't come up so much, but we certainly have private universities with owners that do work for in certain aspects, right? So any wages paid to majority owners or their living relatives cannot be included as well. We touched on this earlier. Any PPP loan proceeds that are forgiven need to be netted out of these amounts. And then finally, payments, including severance payments to former employees, would not be eligible. It would be for services performed at that time. There are also a litany of other credits, work opportunity tax credits and such that cannot double dip. For that reason, we always request copies of your 941s to analyze and make sure that there aren't any of those double dip scenarios that we need to be aware of. And very timely, I probably should have pushed that button a moment sooner. Families First Coronavirus Response Act. This is for paid sick leave if someone had a child who school was closed, had to stay at home to take care of them. All of that goes into the FFCRA funds. So that is a separate credit that obviously we can't double dip on. But if you had people who were out for COVID, if you had a COVID outbreak, that is where you'd want to go. The paid family and medical leave credit also cannot produce double benefit here. I mentioned the work opportunity tax credit, empowerment zone, research and development tax credit, again, not very relevant for this crowd maybe, but there are a whole number of things that we cannot produce this double benefit on. And it's important for everyone to do the due diligence and make sure that we are not producing that double benefit. It really is one of the big pitfalls of claiming this credit. Okay, eligibility. Again, we've kind of covered this, so I don't want to be redundant. I do want to save some time for questions. So these are just the highlights, again, of the two different ways to qualify, either a partial or full suspension of operations due to a government order or a significant decline in gross receipts, varying depending on the year we're talking about in question.
Thank you, everyone, for joining. I know we kept it within our time, a lot of time that we had said. I wanted to open it up right now for any questions. And you could type those questions and we'll give everyone a chance to type in. and you can either do it through the chat or through the question section. Jordan, I did have a question come in relation to, we had a school that's asked if they already filed their 941s and everything is already done, can they still go back and get 2020 and 2021?
Great question. Great question. Absolutely. The majority of these claims are actually going on 941Xs or amended 941s. There is a 3-year open period to look back and claim these credits. So certainly 2020 is still in play. All of the 2021 quarters are still in play, and they will continue to be in play, past 2021 as that statute remains open. There is some current legislation that is proposed in that infrastructure bill. Currently Q4 ERCs are potentially on the chopping block to make way for other spending through the infrastructure bill, but no one has been able to agree on anything in regards to that yet. So they are still in play at this time. But absolutely, we can look back up to 3 years and claim these credits. And generally speaking, the mechanics of actually claiming the credit have been simpler for most of our clients claiming them amended versus on the originally filed 941.
Perfect. Jordan, I had another question come in. How is the credit applied? Does it go on do they get a refund check, or where does that come in?
Oh, another great question. So there's actually an option. There's a portion of it, a small portion of wages that could be non-refundable, but in general, the credit is fully refundable. So you can either ask for a cash refund at the time of making the amended returns, or you can request to apply the credits toward payroll tax withholdings beginning the first quarter after in which you filed, or a hybrid approach of the two. And that's certainly an option for everyone. And what we do on our side, if we're working with someone to prepare one of these credits, we're looking at, what are all the factors? How long would it take you to exhaust that balance if it was on a payroll tax reduction versus what is the general lead time we've been observing on the full cash refunds, and really just kind of come to terms with what's going to be the quickest route to cash, right? I think that's what it's all about for most people right now. We want to get cash injected. That's what the employee retention and credit is for. It's an economic relief mechanism. But there are those two different options of refund or applying towards payroll tax withholding, or a combination therein of the two.
Perfect. I think that's all the questions we have. I just want to thank everyone again for joining. If you do have follow-up questions, please feel free to reach out to us. If you have not looked at the employee retention tax credit for your school or university, definitely reach out to us, and we could schedule a call with Jordan for about 15-20 minutes to verify that you are eligible and walk through the process to help you claim, and more important, support those claims. Thank you everyone again for joining. We appreciate it, and enjoy the rest of your day. Be well.